All right, let's get right into it. We're always hearing about the big, scary risks to the economy, right? An AI bubble, what's going on with China, or the latest political drama. But what if the real force, the one actually pulling the strings behind the scenes, is something way more boring and a whole lot more powerful?
I mean, have you been looking at your own finances lately asking these exact questions? You hear the Federal Reserve talking about maybe cutting rates, but your mortgage isn't getting any cheaper. Stocks seem to panic out of nowhere. It just feels tight. If you felt that, you're not wrong. And the reason why is not where most people are looking.
So here's the deal. It's not any of these usual suspects. These are the loud, flashy headlines designed to grab your attention. They're distractions. The real story is much quieter, it's way more fundamental, and honestly, it's been building up for about 30 years.
Yeah, you heard that right. The answer, the real one, begins in Tokyo. Why? Because for the last 3 decades, Japan has basically been the quiet duct tape holding the entire global financial system together. And, well, that tape is starting to come unstuck.
So, how on earth did Japan end up as the planet's central ATM machine? To really get that, we need to jump in the time machine and go back a few decades.
Okay, picture this. It's 1992. Japan's colossal asset bubble just spectacularly burst. And for the next 30 years, the country's economy just stalled out. They call them the lost decades. In response, the Bank of Japan threw everything at the problem, eventually using a policy called yield curve control to basically superglue interest rates to the floor.
And this is the absolute core of the entire story. For decades, if you were a pension fund, a bank, or just a regular person in Japan trying to save money, your own government's bonds paid you nothing. Zero. Zilch.
So this created a really simple choice for Japanese investors. You could either leave your money at home and earn zero return on it, or you could take that cash and go on the biggest global shopping spree the world has ever seen. You can guess what they did. They went shopping, and in the process, they became the world's #1 creditor nation.
Now, this massive global shopping trip was fueled by a bit of financial engineering that turned into the secret engine for the entire global economy. It's called the yen carry trade.
It sounds complicated, but the idea is actually super simple. You borrow money where it's incredibly cheap, and for decades that was the Japanese yen, and then you invest that money where you can get much better returns, like, say, in the United States.
Let's break it down. Imagine you're some big-shot investor. Let's call you Bob. You go borrow a boatload of Japanese yen for practically 0% interest. Then you immediately swap it for US dollars and buy a US Treasury bond that's paying maybe 4%. Boom. You just pocket the difference. It was, for all intents and purposes, a free money recipe. And listen, we're not talking small numbers here. We are talking about trillions of dollars getting pumped into the system. This money didn't just buy government bonds. It funded tech startups, it bought up real estate, it poured into emerging markets. You could say the whole world was running on free Japanese Wi-Fi. But, there's always a catch. This entire global party relied on one single critical assumption, that Japanese interest rates would stay at zero. Forever. And in 2024, that assumption finally shattered. This is what we call the Great Unwinding. The moment the Bank of Japan raised interest rates for the first time in 17 years, the whole equation just flipped on its head. All of a sudden, borrowing yen wasn't free anymore. That no-brainer, free money trade, it was over.
And here's the thing. When the math flips, the money flips with it. All that cash that gushed out of Japan for decades is now starting to flow back home. There's a name for this. It's called repatriation. And it is, without a doubt, one of the biggest hidden risks in the market today.
Okay, so this all might sound like some abstract high finance game, but this is where the story pivots and starts to directly affect you, your wallet, your mortgage, and your 401k.
The legendary investor Ray Dalio put it perfectly. He said you have to watch the bond market. Why? Because the bond market sets the foundation. The interest rates there pretty much determine the value of everything else. Now, here's a really important point that most people miss. We're all obsessed with what the Federal Reserve does, right? But they only really control short-term interest rates. The long-term rates, the ones that actually matter for things like mortgages, those are set by good old-fashioned supply and demand.
Think about it. For decades, Japan was this huge, reliable customer for U.S. government debt. They weren't too picky about the price, they just kept buying. But what happens when your biggest customer walks away? Well, you have to find new customers, and to get them interested, you have to offer a better deal, which in this case means higher interest rates.
And that right there is how this quiet story in the bond market becomes an everything story. Higher long-term rates mean stock prices tend to fall because a company's future profits are worth less today. It means your mortgage rates stay stubbornly high because they're directly linked to these rates, and it means it gets more expensive for businesses to borrow money, which slows down the whole economy. So what we're really talking about here is this massive, fundamental shift happening at the very foundation of the financial world, and it's a threat that's been hiding in plain sight this whole time.
You know, there's a good reason you're not seeing this story plastered all over the news every night. It's not loud, it's not a simple clickbait headline, it takes a little bit of patience to understand. But the biggest threats are almost never the ones trending on social media. They're the quiet, structural changes that creep up on you.
Maybe the best way to think about it is like this. All that cash flowing around the globe, it's like oxygen for the markets. For 30 years, Japan was supplying a huge tank of that oxygen. Now, someone is turning the valve and the supply is getting tighter. And everyone, eventually, is going to feel it.
So that leaves us with the one final multi-trillion-dollar question. For 3 decades, the entire global economy was built on a foundation of cheap money from Japan. What happens when that foundation finally starts to crack? What happens when the world's ATM finally and permanently